Today we're going to talk about the problem with fair value gaps. We're going to show why they're not logical, and we're going to show you some alternatives to using the fair value gap, which actually work and actually have some data behind them. Okay? So first, what is a fair value gap? A fair value gap is essentially 3 consecutive candles in which the first and third candle have wicks that don't intersect. Okay? Or don't overlap, you can call it that as well. For example, here we have a consecutive candle here, 3 consecutive candles. The first candle wick does not intersect with the third candle wick. Therefore, there's a small gap here, which is called the fair value gap. Here too, 1, 2, 3. First one wick doesn't intersect with the third one, and there we have a gap. Okay, etc. These are mainly used for identifying entry points. And also identifying reversal points, but these are the same things. It's used predominantly in forex and crypto markets, but also in futures and other stuff. Not so much in stocks. So, what's the logic behind the fair value gap? Why do people think this is a good thing to use? Well, the logic is that people believe that prices move too fast for fair value to have been established. So the price has moved too fast through this area for fair value to have had time to be established. Same thing here. They think prices moved too fast through this area here for fair value to be established. What this means in more technical terms is that there are still orders which are yet to be filled in the order book because price moved too fast through the order book for the orders to be filled. Okay, and this in turn provides liquidity, which is the logic behind the reversal or the entry, essentially. A fair value gap in the eyes of the users shows an inefficiency where aggressive orders overpowered market makers to the point that market makers weren't able to absorb the market's buying or market selling, providing this gap. So, what are fair value gaps used for? Well, like I said, it's mainly used for spotting reversal points, and it's believed that the liquidity provided by these unfilled orders in the order book will essentially reverse price once they are filled. So, for example, here, the thought is that price moved too fast through this area for fair value to be established, and therefore there are buy orders here sitting waiting to be filled, and we get filled. Nothing really happens because it doesn't work, but that's the idea here, that it would reverse. It's mainly used on all time frames, and it's 99.9% used on time-based charts. Okay, time-based charts, if you don't know, are charts that print new candles based on time. So 4 hour, 1 hour, 12 hour, 1 day, etc. Next, how often do fair value gaps work? Well, there's a pretty unclear testing methodology because the rules tend to be different from trader to trader. One trader might use one system, another one might use a different model, etc. And they all have different rules and different parameters. They like to stretch and tweak all the time to make it seem like their system works. Okay? The reason they have to tweak their settings all the time and the rules all the time is because if there were strict rules that were held for long periods of time, you could just and if they worked, you could just program a bot or a program to do this for you, to do this trading for you. If there were strict rules behind a fair value gap system which worked, you could just pay some guy on Fiverr $100 to code one for you. Okay, but they don't because they don't work. That's the main thing here. I wouldn't really have to say more than this to prove that they don't work. I shouldn't have to say more than this, but I will, of course. But you can just think of it like this. If it worked, the fair value gap rule is so simple. It takes 2 minutes to code. If it worked, you could just code a bot to do it for you. So, next, the fair value gap and most ICT systems work in backtests, but not in real-time markets. Why is this? Well, I'm going to cover that now. So why do fair value gaps and most ICT models and systems work in backtests, but not in real life. It comes down to three main things. First is overfitting data. Okay, so overfitting data means always doing subtle, either conscious or unconscious changes in rules or the strategy to make it seem like the strategy works. Okay, so changing one thing because you see that it doesn't work, having it that way, so you change it, etc. So doing small changes all the time, essentially fitting the rules to the data you presented. Okay. Next is something called groupthink. It's where a group of people think the same way and therefore reinforcing their ideas. The usage of the fair value gap is common in the SMC and ICT community, and these communities tend to be echo chambers, overlooking any contradictory data that aren't in line with their views and with their models. Okay. Next, it's something called selective analysis. This means essentially choosing only selective tickers, timeframes, times a day, etc. To essentially say that your system works and ignoring all the times it doesn't work. For example, kill zones, silver bullets, etc. is a prime example of selective analysis. First, we're going to cover overfitting. So there's four main chain of events that happens when a new trader or any trader in ICT or SMC discovers a new strategy. They try out the strategy, they see that it don't work, and then they do some subtle tweaks on the rules to make it seem like they work on his dataset. So let's say he finds a strategy on YouTube, whatever, Casper SMC, some other nonsense, goes on gold on the 1 hour, tries it out, sees, okay, it doesn't actually work. Let me do some tweaks in my strategy. Let me only trade after this time. Let me use a different thing. Let me use order blocks, whatever. And now once you have done those changes, it actually looks like it works on the gold 1 hour. But then he goes to the gold 4 hour or the silver 5 minute or anything really. Anything different than the original data set he compared it to. And he sees again, okay, my system doesn't work. Let me do changes again. And this goes on for repeat. It goes on for repeat, and he tries new strategy after new strategy, and nothing works. Okay? This is why ICT himself has failed all his challenges, all his Robin Cups, because the systems don't work when it's not implied on a system, on price action that hasn't already happened. It seems like it's a magic tool when you backtest, but when you actually try it, it doesn't work. Next is groupthink. Okay? Traders tend to absorb more information about the same topic when their implementation doesn't work. Okay? So let's say a trader just learned about the fair value gap, just watched the ICT mentorship, whatever. Any ICT video in reality. They try it out, they see that it doesn't work. And now they start to absorb more content of it. They watch a new video, they read a new article, they buy another mentorship, and it still doesn't work. And this leads to a very, very one-sided information stream. And this further subconsciously confirms for the trader that this is a system that works. Hundreds of people are making videos on it, and hundreds of people are profiting off it, surely. So it surely must work, right? That's a subconscious experience that the trader gets. And once he finally understands, okay, maybe they don't work. Maybe they don't actually work. The traders tend to be a challenge rather than the concepts themselves. Okay? So people say, you didn't do this correctly. You didn't mark out the order block correctly. You didn't do the fair value gap correctly. You were on the wrong time of day. You weren't in the silver bullet time, whatever. Okay? So once they find out the system doesn't work and they challenge the system, they tend to be blamed rather than the system itself. Lastly, it's selective analysis. Traders tend to backtest these fair value gap strategies. They switch instruments, they switch tickers until they find a ticker where it seems like this worked on. Okay, ignoring all the times they have switched. So let's say they start on gold and they keep switching. They switched 20 times. They're now on the franc USD, for example. And I say, okay, it actually worked for this today. And they essentially try to use this one time which is that it worked to mark this as a successful strategy, ignoring the 20 times it didn't work. Okay, this is extremely common, and also another showcase of, for example, silver bullet and kill zones, etc. Selecting random points which they have seen that it worked, and ignoring all the other times it doesn't work. Okay, so that's selective analysis. So why don't fair value gaps work in real markets? It comes down to four main things. First, it's that it's impossible, literally impossible, to view fair value on a time-based candlestick chart. Like I said, time-based charts are where a new candle gets printed in respect to time. Okay. Next, it's that time-based charts say nothing about where trades were taken. So where in the candle people were selling, where in the candle people were buying, where in the candle people were closing, etc. They don't say anything about that. They can't show you that. Third, it's a time-based charts say nothing about how many trades were taken. Okay, you have no clue how many trades were taken and in which price they were taken. Time-based charts also say nothing about where price spent the most amount of time. And this concept here, where price spent the most amount of time, is crucial. It's the main idea behind an imbalance. So we're gonna get into that later. First, it's impossible to view fair value on a time-based candlestick chart. Okay? We have no idea whether a candle actually established fair value or not. For example, we have 3 consecutive candles here. We have a fair value gap between this week and this week. We have no clue if the price action inside this candle went like this, where we had fair value zoom, a part with no fair value, and then fair value again, or constant fair value, but ask absorption, which pushes the price down. So we don't know if there was an actual gap in fair value, or if it was just constant and efficient price moving. We have no idea, again, where price has spent the most amount of time, also called where price has spent the most amount, where price has developed the most amount of fair value. Because if price is at a price point for a long time, it shows acceptance, it shows efficiency, okay? And it shows, lastly, fair value. If price naturally sits at a price for long amount of time relative to the rest, it shows, okay, this is a portion of price where there is agreement, where this is a fair value for the asset. There's no way to see this on a time-based candlestick chart, okay? Let's say, for example, it will move like this, stopped here, was here for like 5 minutes, or sorry, this is on the 4 hour. For example, 3 hours still in the middle here and move down. We would have no time that in the 50%, no clue that in the 50% here, there was actually major fair value, okay? In this case, the fair value gets pushed down because of ask absorption. And in this case, there's an actual market maker inefficiency. Next, time-based charts say nothing about where the trades were taken, okay? We have no idea where in the candle there was acceptance, if there even was acceptance, okay? We also have no idea where the potential imbalance is, because we don't see the inter-candle acceptance. ICT traders tend to use the 50% as a key level, so halfway through the fair value gap, but we have no idea to see this, okay? Because they believe that every consecutive candle like this, whichever, moves like this. They don't. Let me just tell you, they don't, okay? If every of them did, then the 50% would make sense, but there's tons of them that move like this, they move up and down, and when we don't know where trades were taken, we can't see where acceptance is. and therefore we can't draw a level where imbalance is. Okay? Next, we have that time-based charts say nothing about how many trades were taken. We have no idea if the sudden move down or the apparent sudden move down was an actual sudden move down, which we have here, due to lack of liquidity, or if it was a steady and efficient move like we have here. All we see is a single candle. Next, we have no idea if the move on the right here was due to shorts opening or longers closing. Okay, which is also extremely important, because if there's imbalance and price, for example, here reacts off this level, there shouldn't be shorts opening that are the reason. It's orders being filled. Okay, these are two distinctive differences. There shouldn't be market shorters pushing down price, which it usually is because fair value gaps don't work. There should be open interest going down, because essentially the amount of open orders are closing down because orders are being filled. And when we don't see this on a time-based chart, there's nothing we can do. It doesn't show us anything. Okay, so that's another very important distinction. We have to know why price moves down. Okay, if it's liquidity, or if it's actual market shorters in this case, or market longers in the vice versa direction. Next, time-based charts say nothing about where price is spent the most amount of time. Okay, so that means we have no idea where the actual sudden move happened. Okay, we have no idea if it happened here, there, etc. Knowing where price spent the most amount of time is essential to knowing where the imbalances are, because that's what the entire concept is based on. The concept is based on, okay, price moved too fast, so too little time for fair value to be established. So imbalance should be at a place where there was little time. Okay, little time. So the first one here, there was little time below here. This one, it was slightly little time here and slightly little time there. This one, it was about 50-50. Okay, and in this case, if the candle is like this, using the 50% of the fair value gap, which is common, would be completely opposite of what you should do, because you can see here there were most fair value in the 50%. Okay, and using a candlestick chart, we're only assuming that we spent little amount of time in the middle of the fair value gap, for example in here. But in reality, there are several cases where price action is like this, where we spent the most amount of time in the middle of a candle developing more fair value, and therefore making the fair value gap literally useless. Okay, so how do you find imbalances that actually do work? There's three things you should do. You should use a tick-based chart, not a time-based chart. Number two, you should use a time price opportunity chart. And lastly, stick to lower time frames. Okay, so first, using tick-based charts. Tick-based charts filter out bad information and contributes more useful information. They also only take the amount of trades into account, not the time. Okay, so they take the amount of trades into account before printing a new candle. Here we have a 3-minute Bitcoin perp chart. Here we have a 610 tick Bitcoin perp chart. Okay, so in the 3-minute chart, for every 3 minutes it will print a new candle. No matter the amount of trades, no matter the delta, no matter what. For every 3 minutes, it's going to print a new candle. Here on the 610 tick chart, for every 610 trades, it's going to print a new candle. Okay, so what's the benefit of this? Well, on a time-based chart, if there's no activity, if there's no trading going on, price is just flat, it will still print a new candle, giving us useless information. Okay, but on a tick-based chart, it won't print a new candle because there's not enough trades. So it will filter out the bad information, because it will filter out the periods where there are a low amount of trades. Okay. Next, if there's high activity, a lot of trades, a time-based chart will limit the amount of information we're seeing, because if there's tons and tons of trades going on, we want to see how the price action develops. Okay. But we can't see that because we're still in the same candle waiting for a new one to be printed after some time. Okay? So that using a time-based chart, essentially it has the premise of every candle having the same amount of activity, but that's not the real case, right? There's different activity for each candle. But for example, on a 610 tick chart or any tick chart, if there's high activity, it's going to print more candles. If there's low activity, it's going to print less candles. Essentially, only giving you the information you want. Okay? So for example here, we print a new candle every 3 minutes. Here. But in the 610 tick chart, there were a lot of activity. So we printed a new candle all the time until we got this move. This move is the same as this move. But because there was more activity, we can actually see more price action to help us discover this move. Also here, it's going to print a new 3-minute candle regardless, but here there's low activity, so it's not going to print that many. Next, using time price opportunity charts. What these show you are where price has spent the most amount of time. Okay, it looks like a volume profile. You can treat it as a volume profile to some degree, because a volume profile shows you at which price volume was traded more or less. In this case, it shows you where price has spent the most amount of time. Where these nodes here are high, it's a lot of time. Where it's low amount of time. Okay. For example, here, if we can take this first one, we have a small, so a low time node, a node where there's little amount of time. We have a pocket here. So this is an imbalance. This is an actual fair value gap because price moved through it super fast. Okay? And we go up, we touch it, and dip instantly. We have another one. Low pocket node, it's kind of difficult to see because I have a red mark there, but this is a low time node as well. You want to look for a B style or V style, or it's actually a C style or B style. Low volume pocket here, price comes to it, reacts, comes to it, reacts, comes to it, reacts. Okay, here again, low time node here, price comes to it, reacts. Okay, so these are actual real-time market imbalances based on where price has spent the most amount of time. This is showing you it, not just guessing like you're doing with fair value gaps. So in these cases, price has spent little time there, therefore there hasn't been enough time for fair value to be established. So there are unfilled orders here. Last, if you still believe in fair value gaps after this video, I ask you one thing. I want you to stick to lower time frames, okay? Because that sort of builds on the concept we covered here, that price has spent low amount of time there. So if price has only spent like 1 minute there, it's still not that much fair value there. So there's still some value to get from this. This is a 1 minute. You can see all the times it hasn't worked, but for example, it worked here to some degree. So if you're gonna use fair value gaps like most people do, at least stick to lower time frames. Anything above the 1 hour is complete nonsense. Okay, complete nonsense. The lower the time frame, the better. Okay, so yeah. Thanks for watching, and I'll see you guys on the next video. Consider supporting me on Twitter. And yeah, I'll see you guys later.